You should all get a little notice. All right. We're going to get started with just a couple of opening remarks, and then we'll turn it over to Jameson. So the first thing I like to say is our next meeting is November 22nd. And I'm not sure, we're still kind of debating the speaker, the presenter. So I'll communicate that to you once we get that locked up. But the meeting is Monday, November 22nd. And I believe that's the before Thanksgiving. So hopefully you guys can tune in before you travel, wherever you're traveling, if you're traveling. We might be actually traveling this year, right? So that's a good thing. I did want to add one thing. Recently we've sent out a couple of deals, one with Cohen Ezra and the other with Cook Properties. And I want to make sure everyone understands that when we send out these deals, they're not endorsed by us. We are not recommending you invest in them. We haven't vetted the deals. The founders of our group, we may or may not be investing in these. The reason we're sharing these deals is because we were able to secure through our community lower minimums. And that's really what we're trying to present to you. It is still up to you to evaluate the deal. Obviously, we can use our community to do that, but I just need to be clear. The attorneys tell me to be clear that we are not endorsing, we have not vetted, and we are not saying these are great deals. You're going to have to figure that out on your own or use your Left Field Investors community. Another thing I want to say is the infield, the membership group that we have. I just wanted to say we added member profiles. We're trying really hard to improve networking because I'm fortunate. I get to meet most of you, and so I have these conversations with everybody, and I'd like everybody else to be connected as well. So we're working on that. So if you're in the infield and you are on the forum and you click on somebody's username, it should take you to their member profile. And so I encourage you, if you are an infielder, to go in and fill in the information on your own profile so that people can start connecting with each other. We're also very soon going to add a sponsor summary, which is basically a list of a bunch of sponsors that we know of. Again, we haven't vetted them. We're not saying they're worth investing in, but we know them. And it'll give you some highlights about them, what markets they're in, what asset classes, and other things. So that look for that shortly. As always, if you listen to the Passive Investing from Left Field podcast, thank you very much. We would love some reviews. That just helps our community grow. So feel free to give us 5 stars. If you don't feel like giving us 5 stars, please do not leave a review. We're not perfect, but our reviews need to be. So thank you very much for that. And finally, the last announcement before I introduce our guest is Left Field Investors is going on the road January 21st and 22nd. Some of us will be going to the Intelligent Investors Real Estate Conference. I know it's shocking they're letting us go, being that it's the Intelligent Investors, but we're going. And we're going to be there Thursday night, the 20th, and we're going to try, depending on when the flights get in, to get together with other left fielders who are in town in LA or who are going to the conference. And then I know there's like a cocktail party Friday night, so we'll probably hang out after that. And then Saturday night, maybe we'll do something too. So I'd love to meet some people and do some networking. So if you're in LA or on the West Coast, or you feel like getting out of the house and going somewhere, we'd love to see everybody in Los Angeles and Manhattan Beach. And I'm hoping, but it's doubtful, but I'm hoping by Friday we will get notice that they're giving us a small discount for our community. But I've told they're not doing that this year, but I'm looking into it. So if you're going, don't book until you hear from me. The price is going up Friday. So if you don't hear something by Friday, definitely book. So that's all I have to say for that. Jameson is here today. He is going to talk about cash value life insurance. There's been a lot of that in the forums, and a lot of people have been asking me about it. And there's been a lot of conversations about cash value life insurance. We were fortunate to have Jameson on last year before we were Left Field Investors. And so he's agreed to come back. We're very thankful for that. Jameson is an infielder. So he's into real estate. He knows our community, and he runs a team of financial professionals at 21st Century Financial. If you want to learn more about what he does, you can go to jamesonlett.com. He's going to talk about properly structuring a policy and all the things that go into life insurance. And as I've told many of you when I've had our conversations, the first life insurance policy I bought was one that I sold myself, and I did not set it up properly. And it's very important to find an agent who knows what they're doing and knows what you want to do so they can set up your policy properly. You're also going to have to find an agent who's willing to take a little bit of a cut in commission, because the way you structure these policies so that they work for us, for investors who want to use the cash value to invest, the agent is going to have to take much lower commission than if they set it up the standard way, like I did my first ones. And then I learned a little bit more and I started structuring them properly. And now Jameson structures them for me. And I've told, again, another thing I tell everybody is it is important to find an advisor that you know, like, and trust. And that means if you don't know somebody, the best way to find that is the way we find sponsors now, which is from referrals. Find someone that knows somebody already. So if you have a financial advisor and they haven't brought this up to you, the question is, why not? And if you bring it back to them and they don't know what they're talking about, you might want to find somebody that does. Jameson's a great guy. There's plenty of other good advisors out there. So just ask somebody in the community and someone will give you a name and you can call them up and try them out. So with that, Jameson, thank you for being here, and the floor is yours.
Thanks, Jim. I love getting an intro from Jim because it's my chance to hear him have to say nice things about me to a large group of people. So if you could enable it so I can share my screen, Jim. Yeah, I think that's a good intro. My goal is going to be to kind of walk through some things that a lot of you probably already know. Some of you could be totally new to you, but hopefully I can give you one or two even new nuances that maybe you weren't aware of before. But this should arm you to then go and find that agent. You know, life insurance is one of those things. Yeah, you can buy it online, but you can't do this online. You have to find a life insurance agent to do it. Someone's getting some commission somewhere. So go find someone, or if you have an agent, this is something where you can go back to them or a financial advisor, and just arms you with the right talking points. And I'm going to give you a couple terms to remember, but I'll try to keep the industry jargon to a minimum if I can. So maybe let me start here just to kind of gauge where people are at. And of course, you don't have to answer if you don't want to, but just maybe a show of hands, just wave at me. Anyone on the call or with their video on that currently is utilizing a cash life insurance strategy? You can just maybe wave at me so I can kind of get an idea. Okay, yeah, we got a few people. How about if you're maybe actively considering? It's not something you've done yet, but it's something you're really looking into. Okay, a few more. How about maybe familiar with it, but really not looking into it, haven't given it much thought, but you've heard of it. And of course, finally, how about anyone who has absolutely no clue what's going on? Hey, bud.
My mom's getting seven.
It is? Oh, that's good. Thank you. All right. See you, bud.
We'll call him after this now.
Cool.
God, you financial advisors will go to any length to sell stuff, won't you?
That's right.
Yeah, you are.
Cleverly placed. I was a little nervous because he had no pants on. So, but I was angling, I was judging the position of my laptop as he approached. He's a tall kid, so, and I know we're recording. Lastly, I think, I don't know if I asked this or wanted to see it, but just anyone who has no clue what we're talking about, cash life insurance, not really any idea what that is or how that works. All right, so everyone's got maybe some familiarity with it. So let's see, I'm going to share my screen. Just while I'm doing that, any questions that you have right off the bat? Actually here, speaking just of, how we'll do anything. I forgot this is going to be my talk about my family, about me time, but I'm going to skip this. But in the spirit of Halloween, this was our Halloween picture from last year. So my wife, Crystal, my 3 kids. Don't ask me what my oldest son is. I don't know. That's what he wanted. He picked it out, and it was terrifying, absolutely terrifying. All right, so while I'm just pulling up a whiteboard here, any questions that people want to make sure we cover about life insurance or otherwise, questions for me or anything like that?
I'd be curious to hear any comparisons to like indexed universal life or the other products that are out there nowadays.
Yeah. Let me, I'm going to take a note to make sure I hit stuff. That's a good point. Yeah, because I'm going to talk about whole life insurance specifically. Because if you understand whole life, you can understand all of the other types with just a couple key differences. So let's see here.
I
All
also have
right,
a
all
quick
right.
question. if
Yeah,
I
go
could
ahead.
ask. Just wondering how diligent should I be about note taking here? Or are there going to be any handouts or information afterwards that would minimize my need to take notes?
That's a great question. You know, in my line of work, handouts require approval from a department at my back office. So I don't know if there will be any handouts.
Okay.
So I would suggest note taking. I guess screenshots are probably fair game. I don't really know the rules in this this new age. So that's what I do though. As people are going, I just hit I'm you know, control print or whatever and take screenshots as I go. So I can't promise any of my, yeah, go ahead.
The recording will be posted tomorrow. So there's
Okay.
also that.
Oh yeah,
good
thank
point.
you.
Good point. Thank you.
Yeah, great. Any other questions? Awesome. Well, as Jim said, my goal then, you know, he mentioned the recording is going to be posted. So my thought is, you know, if I give you too much technical stuff today, that's okay. You can go back and just watch again. And I also apologize because I'm going to have to angle my computer here. You're probably going to be looking at my nose a little bit. So, but you'll just have to deal with that, I guess. So, so let me just start with some basics, and then we'll get into maybe some numbers. I put some ledgers together so that we could actually look at numbers and see how some of this stuff interacts. But I just want to start with just a simple concept. So, oh, look how thick that is. Hold on here. Let's see. So let's start with, you know, what is life insurance, right? So we've got an insurance company. And if you've got a life insurance policy, that's basically a contract between you and this insurance company. And that contract's bilateral. It says you're going to make payments, a certain amount of premium payments, and they're going to supply you with a death benefit. So let's just say $1 million, $1 million. And that starts, that $1 million pays out starting today. If you put it in force today, goes all the way to age 120 is when they have policies mature. So never had this happen, but I guess if you're still alive at 120, they just give you whatever the death benefit is. You don't even have to die. So, Sean, you got to stop texting me, okay? Actually, that was somebody else, I think. So, all right, so you're going to put in a premium. Again, I know we're a little elementary, but I think it's a good place to start. We're going to call this base. So you put in a premium, and they set this up on a schedule. So it's almost, think of it like, you know, when you structure a loan, there's an amortization schedule, right? So there's a amortization schedule based on how old you are. That determines what your premiums are. And then you're going to build, again, we're talking about whole life. Whole life is based on a set of guarantees. So there is guaranteed cash in your policy that grows at, it's not so much growing at a guaranteed rate, it's actually more of a guaranteed schedule. So that schedule is going to increase by a certain amount every year, right? So you're going to put in a premium. By the way, just if you have a question, just interrupt me. I'd rather do that than kind of save them all till the end. So you're going to put in some base premiums. Guaranteed cash value technically is considered a return of those premiums. So whole life is kind of like the OG life insurance. It's a couple hundred years old, older than the stock market. So this basic structure I'm laying out has been around for a long time. And I'm going to show you, of course, what we're going to talk about today is some of the changes that have developed, some of the bells and whistles. So let's see. When you do whole life insurance, ideally we like to look at mutual companies. A mutual company means that the policy holders are also shareholders. So there's no magic to it. It doesn't mean that that's automatically a better company to work with or to use. But it's just one of those items you might put in your list of questions. A mutual company, if your shareholders are outside investors, then you might think, okay, I've got quarterly numbers to hit for these outside people. When your shareholders are the policy holders, now you're making decisions for those people, right? So it's a preference. I wouldn't say it's a necessity, but just as a quick note. So that insurance company, then they're going to pay dividends into the policy. So they're going to add some funds too. I'm going to switch colors up here actually. So now dividends aren't guaranteed. So what you'll hear a lot with whole life insurance in particular is there's guaranteed parts to it and then non-guaranteed. So there's no guarantee a company is going to pay a dividend. But when you look at a lot of these companies, mutual companies, even non-mutual companies, all companies were mutual at one point, pretty much. Most of them demutualized in the 80s. But all of them have, or a lot of them, I should say, have paid dividends forever. So we'll look at a ledger tonight with one company that we do a lot of this type of business with. And I think they've been paying dividends since, let me think, it's like 175 years, maybe. So since they were founded, they haven't not paid a dividend, but they might pay more or less. So when it comes to whole life, this is the part that you need to look at in terms of what are the variables, like what could go one way versus another way. It's going to come down to those dividend payments because the base structure of the contract, it's built on guarantees. So when I come back to, and I sorry, I forget who asked it, but we talk about universal life insurance at the end. I'll give you like the two differences. Basically, you're just getting rid of the guarantees and you're adding potential, more growth potential. So the insurance company is going to pay a dividend. Now, this is where we get a little more complex, and yet I'm, still using my rudimentary drawings here. So that dividend goes in, and it does two things. There's different ways to structure and set this up, but this is kind of the basic. First, the dividend is going to buy additional death benefit. It's also going to go into cash. Next year comes around, they pay another dividend. More money gets added to cash. So these additions are called paid up additions, PUA. That's a good term to write down. Every company will have a different name for this feature in a contract, but paid up additions is the general term that advisors use because it's like you're adding little paid up life insurance policies on top. That's where the name kind of comes from. So now when you take money out of a policy, you do this. Oh, wait. Oh, I just wrote paid up additions. So let me draw another one here so my Control Z works better. When you take money out of the policy, you're releasing those paid up additions. It's like you're selling them. So your death benefit and cash are going to go up over time. You take money out of the policy, those two things are going to move down. All right, I'm pausing for questions. Nothing yet. I'm going to throw in one more mechanic. I know I'm going a little fast. Again, you can rewatch the recording. So one more aspect to kind of the basic structure then is that you can also put in extra money. You can put in more. Paid up additions rider. Again, every company is going to have a different name for this feature. It's basically an additional, we call it a rider, right? Because it's added to a contract. And this allows you to add extra money. Now, why would you want to put in extra money? Well, we'll talk about this here in a second, but the costs of the policy are already built into that base premium. Right? Because that was the original schedule of premiums and everything. So when you put in extra money, you're not really having to worry about the cost of insurance that was set up in the policy. So you're able to put in extra money. That just means more money that goes towards the cash. So now you're doing this and you've got things just building a little more quickly. All right. Anyone thoroughly lost or confused yet?
Hey, Jameson, just for clarity,
Please.
the blue lines and the green lines that are the diagonal ones, that is
Yes.
the increase in cash in your policy. And the lines that are above at the top, that's an increase in the actual death benefit. So it started at $1 million. And by the time you're up to that second green line, your death benefit might be, 1.2 million. Right. So it keeps growing. So the death benefit keeps growing as the cash is growing, just so everyone kind of understands that.
Thank you, Jim. Yes, you got it. So I'm going to build on this for a second and just to kind of make a couple points here. I've got like 17 windows open on my other monitor here. So let's jump back here. Let's see. So all right, so we started to talk about this a little bit. My biggest problem, guys, is that I can't figure out where to put your all your faces. So I'm just moving you around so that you're not in my way. But I don't want to get rid of you. I like to see you. So, all right. So we talked about the paid up additions rider. So let's come back to now we've got that understanding for, like Jim said, what makes up the death benefit. There's a few different components potentially in the policy that you're trying to structure. Same with the cash. There's a few different components. So we've got, cash building up, right? And then our death benefit, we started with $1 million. That's building up too over time, right? Let me extend this line here. Like Jim said, so you get this exponential curve that you're probably used to seeing on if you ever calculate compounding interest for something. And then let me point out a couple things. So one, there's a corridor here. The cash and the death benefit never equal each other. But you see that the corridor is a lot more narrow than where we started, right? That corridor, there's two ways to look at it. One, that is the cost of insurance. So at the beginning of a policy, the cost of insurance is much higher, right? Because the company, right, you've given them one premium, but they still owe you $1 million in this case if you die the next day. Over time, though, you've built up a lot of cash. That company's in the general account, or it even could be in a separate account depending on the policy you're using. But it's still on the in the account of the insurance company. So there's another way to think of this number is the net amount at risk. Whose risk? The insurance company. So at the beginning of the policy, the net amount at risk is huge, right? So when we look at some illustrations, you'll see, okay, wow, that's a big risk. Well, they're also not going to give you any benefits early on. In fact, you'll see that if you're just looking at the first year, this could be one of the worst uses of your money that you could use if you're looking at the first year, maybe even the second, okay? We'll look at that in a second. But so cost of insurance or the net amount at risk is that corridor. They have to stay separate. And then there are a couple rules that govern this and like tests. So like you can only put so much money in. this basically the black lines that I'm drawing, I'm sort of starting out with a basic structure. That's what you are setting up when you start, is a basic structure that says how much money can I put in and over how much time. So we'll spend a little more time on it, but those are the two things you have to be careful of, is putting in too much or taking out too much. So overfunding, over loaning, or over withdrawing. We'll spend a little more time on that later, but you get basic structure here, and then okay. So now it comes into like moving pieces. So, and I think probably if you're doing this strategy, or if you've looked into it at all, you might not have all of these terms, but you're going to know most of what we're talking about even up to this point. So we started with $1 million of death benefit. So what happens if we lower that? Let's keep everything else the same, but lower this death benefit to say 500,000. So we're going to cut it in half. So this is our new death benefit. And that's going to then travel along this line, just like all the others, just like the other one would. What happened to our cost of insurance? Half, right? Went way down. I was waiting for people to say something, and I realized you're probably all muted, so which is good. It's probably good. So yeah, cost of insurance now is half. So if I'm putting in the same amount of money, but only half, but the cost of insurance is cut in half, right? So my premium, let's say 50% of it covers the cost of insurance in any given year. So in the first year, like all of it goes to the cost of insurance. Well, if I cut my premium in half and put in the same amount, well, now half my premium can just go into cash in the policy because the cost of insurance is so low. So, so this is lowering the death benefit. As an aside, this is not what I think the purpose of our call is, but you can even do the opposite. You can ratchet up the death benefit. So if your goal is, I want to leverage the death benefit, if that's the thing you're after, you're going to go one direction. If your goal is, I want to focus on the cash, then you're going to bring the death benefit down, go the other direction. So the first sort of, I don't know if it's a teeter-totter or a seesaw. I think those are the same thing. I think one of those is if you were born in the 70s. The other one is if you were born in the 80s or somewhere. And maybe, I don't know where the cutoff point is. But think of it as the seesaw. So if I want more cash, I bring my death benefit down. If I want more death benefit, I'm probably going to sacrifice the cash value to get that death benefit. Make sense so far?
Hey, Jameson, one quick question about that. Can you,
Yeah.
I've talked to some other insurance agents previously, and you know, if you want to lower that death benefit to get the most cash value, but also cover kind of a short-term death benefit risk, you can layer in like a term policy for a certain period of time. Is that true?
Yeah. So I was debating how much to go into that.
Sorry.
No, it's okay. So you could do it two ways. You can have your cash policy be separate and get a term policy separately from that. Sometimes that's an ideal way to do it. And just from a big picture standpoint, right? If you're getting life insurance, you need the death benefit has to be a need, or the insurance company won't give it to you, first of all. But then second, like, get the life insurance you need. So if you want to do the cash policy, and let's say you need $1 million of life insurance, but your cash policy is only 500,000, get the $1 million first, and then do the cash policy and subtract from your term insurance or whatever, because you want to, protection is just always, it's not the sexy stuff, right? But it's important, right? For your family and all that stuff. Have an umbrella policy, have your estate plan done, all of that stuff. Okay. So I'm here as an insurance agent. So I'm going to tell you, don't do all the insurance, just do the big ones. Do the big ones that you can't afford to risk. That's my PSA announcement. So yeah, so you might want to get them separate. There, you can also blend them in together. And I'll show you an example. I don't have a way to draw it, at least not that I've practiced or tried before because it's a little too complex. So, but you can blend term insurance in to a policy, and that will change the makeup. That'll change how much death benefit, how you build cash. So I think the overall point, Chris, would be like you mentioned, you're having these conversations. That's the good thing, because you can structure these so many different ways. It's not like there's just one way to do it. It's a little more nuanced, which is actually kind of the second, sort of the next point, is that cash value and death benefit is the first teeter-totter. But there's another one, and that's speed versus size. So I'm going to switch and leave my drawings here for a second and pull up a, let's see, it's 7:30. You know what? I'm actually going to start at the end. I'm watching the clock, and I'm going to start at the end, and then we can walk backward with whatever time we have. So, so check this out. I've got my Jim Halpert here to give us a demonstration. So over here on the left, this is just pure premium. So what that means is this is just a normal whole life policy. It's not been structured at all. So that $100,000, that is base premium. You're going to see, let me point out a couple things. 100,000 goes in. That is the balance of your account at the end of year one. So what I like to ask clients is, before you do this, and what I've learned is, if there's one thing, there's all this information, right? So people only retain maybe 10% of what you throw at them. So I try to emphasize this point. Is this a good investment when we do your annual review next year? One time I had someone say yes, but they confessed they thought it was a trick question. They thought I was trying to trick them. And so I was like, no, no, it would be, yeah. I was like, okay, yeah, no, that's bad. And I'm like, okay. And you loved it so much, you did it again in the second year. You put in $200,000, you have 120. They're like, 120,000? No, you have $120. Oh man, this seems like a terrible idea. And usually they're thinking, why is he trying to get me to do this if it's so bad? But it's not actually that much better though, as we structure the policy. So I just wanted you to see though, like those first years, remember the net amount at risk to the insurance company, it's everything. Not to mention they probably spent money on your labs, onboarding, all that stuff. So the insurance company has lost money in the first year. If you die, it's like their worst case scenario. So you don't have any cash. Now we can start structuring, right? So we bring the death benefit down, and look over here. Brought it down to $2.7 million. So kind of cut it about in half, a little lower. I'm still putting in $100,000 a year, and look at my cash in the first year. So I should have probably saved my client story for this, because this is typically how we're structuring a policy. So I would, but still it's the same conversation, right? You put in $100,000, you have $76,000 in your account. Was that a good investment? No, it was not. Not in the first year. So that's the important thing to kind of remember. No matter how you structure a policy, you're not going to have the money that you put into it at the end of the year. Okay, and it doesn't matter which company you use. Some illustrate better than others. These are probably, these illustrations are probably some of the best you can find in my experience. But even still, it doesn't matter how you structure. So we're putting in $100,000 a year. And then let's just say, okay, year 9, we've got $1 million. And then just jump over here for a second though. So this is the same thing. We've structured the policy the same way. It's 2.7 million. So the death benefit's even just a little bit lower. But notice the cash value, 52,000. And if I look at year 9, I've got 950,000. So I'm about 50. Well, I guess I'm actually more like $80,000 behind on the right. But as maybe you're guessing, if you're kind of looking at the headings and stuff, speed versus size. What happens in year 10? Why does this say $67,000? Over here, I can put in another 100. Over here, I'm actually capped. I can't put more money into it. I chose speed. I wanted to get to a point by year 9. I wanted as much cash as fast as possible so I could start taking money out as soon as I could. Maybe I wanted, well, I won't give examples. I just remembered. I won't give examples, but the cash value is money you can take out and use for whatever you would like. That's the way I'm going to say that. So, but so you got $1 million here, 950 here, speed versus size. Obviously, if I can keep funding my policy at a certain level, then I'm going to have more money in it, right? So it's important that you look at the long term. Now, even on this example on the right side, I still run into a limit. This is overfunding. So I backed down my premium by $3,000 so that I didn't overfund. When you overfund a policy, it creates what's called a modified endowment contract. That's not a bad term to know. MEC, we often just call it meching a policy or a mech. Modified endowment contract is like life insurance, but without the tax benefits.
And Jameson,
It's not good. What's up?
sorry to interrupt, but just for clarity, when you're saying you're not putting in 100,000 in these policies, it's because you cannot. Otherwise, it will turn into a mech. It's not that you're choosing not to, but the way you funded the policies, if you put extra money into it, then you lose all the tax benefits.
Correct. So I ran the illustrations to see what is the maximum amount of money I can put in a given year. And there's different ways that the IRS looks at a policy to say, have you overfunded it or not? It's nothing that you need to learn. There's a guideline premium test, a cash value accumulation test, and there's a 7-pay test. So what you'll see sometimes in illustrations is every 7 years, there's a little bump in how much you put in. It's because we're following the 7-pay test. You want to, if you do something like this, you want to run what's called an in-force illustration on probably an annual basis. Once a year is not too much. If you're not really doing anything with the policy, you might be able to get away with running one of those every 2 or 3 years. But that in-force illustration is going to take into account the dividends, money you've taken out, if you've done loans. It's going to take that into account so that you can recalculate those mech limits, because the performance is going to be variable. When you take money out, that's another variable. So now the mech limits become variable. So it's not like you set it up and you can just forget about it. But the nice thing is, if you do that every year or so, you can see that mech limit coming a mile away. You can see it coming 10, 20 years down the road. And then so you can just put less money in, you can start putting less money in if you're getting close to that limit. Same with taking money out. When you start taking money out, you rerun these in-force illustrations just to make sure you're not in danger of taking too much out. If you take too much out, that's called a surrender or a lapse. If your insurance policy lapses and goes away, you don't have life insurance anymore. The reason that's bad is not because the death benefit's gone, it's because the contract's gone. The contract is what gives you all of the tax benefits. So just as an example, if you are over in year 20 and you've put in, and we've got $3 million of cash value, and say we had all $3 million out in a loan, 3 million minus say the 2 million we've put in, you owe taxes on $1 million if you lapse your policy in year 20. Now, again, this is easy to avoid because every year, if you're working with an agent, you just run an in-force illustration, see how much money you can still take out, see how much money you're putting in. And for us, they used to have to figure this stuff out with like pen and paper. Can't imagine what that was like. We've got software. We just run the software. And if we need help or maybe some expertise, we all have back offices with, tax and legal experts that can help make sure that we're running everything correctly. So anyways, so it's a big deal, but it's also very easy and simple to avoid. I think that's maybe what I want to stress. Over loaning, taking too much money out, over funding, putting too much money in. So yeah, thank you, Jim. That's the policy in the middle is maximum funded. We chose speed over size. The policy on the far right side is, you know, sort of in the middle, right? It's okay, we want size, but we also want to build cash. And so it starts with kind of figuring out those goals. What are the goals? When do I want to take money out? How long do I want to fund it? I was talking with someone recently who mentioned they're like, well, you know, I'm going to fund it for 9 years, but then I'm going to retire. And they're like, well, after I retire, I'm actually going to have a lot of extra cash flow. I'll probably just keep putting money into it. Okay, well, then we should design the policy to receive those funds. You don't have to put that money in. So, you know, after the first, you know, you definitely want to start a policy that you think you can fund, right? You want to have a good idea, like, yeah, I'm comfortable putting this much in. But you want to know, I think the other question you might bring to the table here is, when can I stop funding it? Like, what's the soonest? How early could I stop? In some cases, you could have flexibility to miss the payment the second year. You could stop funding after year 3. That's on the early side, but if it's structured that way, then it'll work. So you want to have kind of a long-term mindset. You also don't have to put in $100,000. You could put in 50 or 25. There's a lot of flexibility with how much money you can put in, but the first year, how you set it up, you know, you want to sort of structure it to be like, yeah, I think this makes sense. And that's more of that conversation you have with your agent to kind of see where they should be asking questions about your budget, your income, cash flow, what other things are you doing and funding, because you don't want this to get in the way of something else, right? So if all of that person does is, you know, sell life insurance policies and life insurance does everything and put all your money in life insurance, well, that's not great, right? Because you might be doing other types of investments or saving other places. So you want to make sure the funding fits in with sort of the broader picture in your goals. So it's 7:45. I could keep going, but I feel like I should maybe pause and open it up for some questions. And I skipped all the ledgers, which is diving even more into the weeds. But I can do that if people want to.
I think it's a good time for questions, Jameson, and we can go until 8 o'clock. And I guess the one question I do have is those 3 examples you showed, you're showing the net premium outlay. So the base premium you talked about in your drawing and the PUAs, that's what's different here, right? And making up numbers, like the first one is just base premium of 100 grand. And maybe the middle one is 60 grand of base and 40 grand of PUA. And the other one is something different. So
yeah,
can you talk a little bit about the optionality of putting in the PUAs and how important it is to make sure you pay the base until you can be done with it? Because I think one of the confusing things is there's so many options. Like we could stop paying, we can keep paying. Like how does all that work?
Yeah. So yeah, I got a call from a client this morning that was like, I'm confused. Do I have to put more in or can I put less in? And of course the answer is, well, yeah, you don't have to put the money in, but if you don't put the money in, will the plan still work the way you wanted it to when you set it up? So, so on this, let's go to, Jim, you were right. So on the premium one, I have a ledger right here. I'll just touch on a couple parts of this ledger since a lot of you have maybe seen them before. $100,000, like Jim said, of base. So here's what they guarantee, nothing, except your death benefit, of course. And then dividend, not the first year. Every company is going to be a little different. I'm not trying to advertise a company here tonight, but I had to use an illustration. So right, no cash value, death benefit. So base premiums are being paid. There's a guaranteed increase in cash value every year. And the guarantees, think of this as like when am I cash flow positive? On a guaranteed basis, it's year 12. Now, when you factor in the dividends, which is the only difference, right? Remember our stick guy putting money in and then the dividends coming in. Let's see, increase in cash value. With the dividends, we're cash flow positive in year 4. That's a little sooner than I thought, to be honest. I don't structure policies like this, so I haven't looked at an illustration like this in a long time. So if we want to make the policy bigger, I'm going to start there. I just added a column. So remember, where is it? Well, this guy. Remember base premium and PUA premium. Base contract premium here, the contract premium. And then we have this, you might not know what all these letters mean, but maybe you recognize that PUA in that section. That's the paid up additions part of the premium. So, so here's what Jim was just talking about. In any given year, the base premium is what has to be paid. Now you can pay it, you have to pay it the first year. Your policy can pay it for you. The dividends can cover it for you, but it has to be paid. So the policy can pay itself at some point down the road. That's the idea. You pay it, you pay early on. The base premium builds cash, like we saw in the first illustration. It does build cash on its own, but we build cash more quickly when we're adding an extra, right? We lower the death benefit now. We're putting in the same amount of money. So $55,000 goes in. And now look, our first year, we have a guaranteed $52,000. And look, it's not much, but it's more than zero. Dividends $833. That goes on top. So now we're building cash more quickly, right? And then over the long term, you're going to have more cash in the policy, and eventually your death benefit will potentially be more as well over time. So I'm going to just throw one more wrench in there. And again, you might be going cross-eyed if you're not used to looking at ledgers like this, but we asked about getting a term policy. I just added another column. Chris, this is the PUA section now. Now it's $70,000, even more. And look at this, contract premium, FPR. Basically, that's this company's term for a term insurance policy built into the policy. So what does that do? It actually, if you look, our death benefit's actually more. It's 2.75. The other one was 2.7. So what that is doing is, remember the cost of insurance at the beginning of the policy year? Well, now we're taking some of that cost of insurance and putting it into term insurance, so that cost is lower. And then then we have our base premium. So in a given year, you have to pay the base premium. If you want to have the term rider, you have to pay that. And then this $70,000 is optional. Now, here's one thing. So this is going to go faster, like we looked at before, but you're going to be limited into how much money you can put in. So that's one thing, right? Speed versus size. The other part of this, though, is that term policy that you just put into that we blended in, the contract premium is not guaranteed necessarily. So it could go up. So if the cost of that term insurance goes up, then that's another variable that you're introducing to the policy. So if all things are the same, I like to keep variables out, right? Whole life has all these guarantees. If you're doing other types of investing, this is typically where we get the most guarantees. And so, you know, if that's attractive to you, it might be nice to leave the term out of the situation, get a separate policy so that the two things act independently, but you can blend them together. The reason to blend them, though, is going to be speed versus size. And it might be, maybe, Chris, to answer your question, if there's a certain death benefit that you're trying to hit, because it's like, I need $1 million of life insurance, but my cash policy is only going to be 500,000. Maybe I blend term insurance in to get up to $1 million, or maybe I keep it separate. It'd be worth looking at it both ways. So separate is usually simpler. I find there's value in simplicity. The more complicated my life gets. But again, if you're going for speed and, you know, if it's the right amounts, you could also blend it into the policy, and that's worth looking at too. Other questions? Or Jim, did I answer yours?
Yeah, let's open
Basically
it up
took-
to other questions now. That's great.
Perfect.
So I was curious about the you mentioned the tax benefits. Are there specifics there, I guess?
Yeah. So I had like this outline in my head of like purpose, pros, and then pitfalls. So some of the potential pros are the tax benefits. Probably the easiest way to think about it is that your life insurance policy, everything inside the policy grows tax-free. And then when you take the money out, you can take all of it out tax-free. Now there would be, if I was putting this in writing, there'd be asterisks, right? So the money's tax deferred as long as it's in the policy. If you have the dividend sent to you in cash in your checking account, that's income, you got to pay taxes on it. If you have it reinvested, that's going to build up tax-free. If you want to take cash out of your policy, just withdraw from it like a bank account or anything else, then life insurance is what we call tax preferred. You take out the basis first. Some people might know the terms LIFO versus FIFO, first in, first out, last in, first out, kind of industry jargon. But if you have an investment account and you sell shares, take money out, right? You're taking gains out first. So you got to pay taxes. Life insurance, you're always withdrawing basis first. But most of the time, guys, you're going to take funds out in loans. Loans are not income. So you don't have to pay any taxes on loans, including once you've spent through your basis and now you're spending the dividends and the gains. If they're all loans, that's all tax-free too.
So
and then the death benefit transfers tax-free, to your beneficiaries.
and if you make an investment with the loan and there's proceeds from the investment and you put that back into the policy, is that tax-free as well? Or are you taxed on that?
So walk me through that
Returns.
one more time. If you take funds out,
Yeah,
make an investment, and then put that back into the policy.
well, yeah, so let's say I had a policy and I took 50,000 out to invest in a multifamily syndication, and then I got a return from that. Is that return taxed or not taxed?
So the return happened outside of the life insurance. So it's going to be taxed according to, so if you just did that and there was nothing else involved, again, I'm not a tax advisor, but yeah, you would owe taxes. If you made the investment inside of a Roth IRA or something, right, then, or an IRA or self-directed 401k, then you wouldn't owe taxes, I would assume, because you're inside of a tax vehicle. So when you take the money out, if you do an investment, then those tax laws would govern that. So you would obviously want to look at the syndication is going to have bonus depreciation and stuff like that. But then you put the money back in your policy. Once it goes back in, now it's on the tax-free train again. It's going to grow tax-free, create dividends and compound tax-free, and set you up to take money out again later that is, again, tax-free next time you take it out. So I was just going to add, there's this could be a part 2, to the series, but a policy where you are, a lot of times how we structure a policy is, I'm going to start this policy. I want to start taking money out in year 2 or year 3. Usually you got to at least wait like a year, right? While stuff builds up. You don't have to, but normally for the dollar amounts you're trying to do, you might want to wait a couple years. Pull money out. It's kind of like a car. Do you have to change the oil at 3,000 miles? You don't have to. Thanks, Chris. Have a good one. You don't have to change the oil at 3,000 miles or 5,000, but you should, right? Maybe you could make it 6,000 or 7,000, but eventually the car's going to seize up. So if you're going to take money out every year for an investment starting in year 2 or 3 early on, a good idea would be to take those profits and recycle them back into the policy, have that pay down the loan, have that build up more cash, and create this cycle, right? Cash comes out tax-free, do whatever you're going to do with it. If there's gains and profits, bring those back into the policy and get this sort of recycling type of thing going on. That keeps things very tax advantaged. And it also treats your policy, it's like changing the oil on the pumps. You're going to get more mileage out of it because you're keeping those loan interest rates and things like that at a minimum. So
Hey,
you can do an
Jameson,
illustration to look at it, but obviously I didn't do that. What's up?
Sorry, can I add to that?
Yeah,
You know,
please.
if you take a loan, talk to your accountant and all those caveats, but if you take a loan, the interest on that loan can be tax deductible that you're paying back to the policy. So there's a couple things going on. One is when you take the loan, your insurance policy should perform almost the same as if you didn't take a loan, because you're not taking money out of your policy. You're using the cash as collateral and the insurance company is giving you a loan. So the example is, you know, we do ATMs, right? We talk about that a lot. If you take $52,000 out of your cash value, put it in an ATM, then you get the $1,100 a month or whatever, and you just pay that back to your policy. That pays down all the interest and a lot of the principal. And you just do that for 4 years, and your loan will be paid off, the interest will be paid off. And then for the next 3 years, you're going to collect, you know, 12.5 grand a year, or whatever it is, whatever the actual numbers are. And so this life insurance, it allows you to create an asset out of nothing, right? Because you're using money, funneling it back into the policy. You're also getting a few extra benefits because you're paying, you're deducting the interest cost off of your tax returns. So the whole purpose of what Jameson would set up is to do, Yuri, what you talked about, is to invest in a syndication of some kind. And you have extra tax benefits, but you're just using velocity of money because $1 is working in 2 different places at once. And so what you need is someone like Jameson or somebody else to create this policy that throws off this cash that you can use to invest. And that's the beauty of it. And it just has to be set up properly and used properly as well.
Well, then you get the bonus depreciation, hopefully on whatever your syndication is in as well. That helps with your taxes also. So it compounds quickly.
Yeah.
Absolutely.
Yeah. Great questions and comments. What else?
Hey, Jameson, can you talk about 1035s?
Yeah. Yeah, sure.
And
Steve,
like,
thanks.
and also like how much in terms of, because if you have like a regular whole life policy like I did, I had that a long time ago. And if I want to go into, say, Penn Mutual or something like that, how much would I lose in terms of fees to the new, agent, that kind of thing?
Yeah, that's a good question. So how much would you lose will depend on how it's structured, right? But let me give you kind of a general idea. So for those of you wondering or not familiar, 1035, similar to 1031, right? So you can take the balance of a cash policy, especially if you've had it for a while and you've got a lot of gains, you can 1035 that into a new policy and you don't have to pay any taxes. You can even move it into an annuity, I think, as well, although I've never done that and I don't know why someone would, but it's possible. So 1035, there are reasons to do it. I would always say proceed with caution, because if you noticed from the illustrations or from many of my stick figures, right, things get better over time. And they start off, if you're just thinking about cash, they start off like not good, and then they become really good, right? On a risk adjusted basis, you're taking no risk in terms of markets and things like that. And the returns you're getting for that are better than what you can do in other avenues. I'll just say that. So, but you got to start at year 1, right? Like everybody else. If you start in year 10, then I would change my tune. I'd put all my money into life insurance. But you don't, you start in year 1. So if you're going to take a mature policy that's been around a while, which there could be reasons for. So if I'm going to answer your question, Steve, but also bring it back to the question about universal life. Universal life insurance is very sensitive to interest rates. So if you're concerned that interest rates could remain low for a long time, if you're concerned that interest rates could go negative sometime or go lower, all of those things are going to make universal life perform poorly, worse than advertised. And this has been my experience when I've been working with agents. They will tell you this is index universal life. It's indexed to the stock market, but the only risk is what the stock market does. That is not true. It's really not stock market risk at all, because they're buying options, the insurance company, on the stock market, and the market's going to do what it does, right? It's going to go up a certain number of years and down. Of course, if the market never goes up, then the policy doesn't work, right? Obviously. But the market could go up every year and be lights out. But if interest rates go down, the interest that you earn every year in a universal life policy, pretty much regardless of what the type of policy, the type of universal life, is also going to be affected. And so the policy is going to perform poorly. So that's just my disclaimer. You want to talk through that more. But I bring that up to say that that's a time when I've seen 1035, Steve, be a good idea, is universal life and moving funds into whole life from universal. I've also seen whole life policies that just like, aren't performing that well and don't really have a good projection of performing well. As another left fielder put it to me once, is the juice worth the squeeze? And I liked that phrase a lot. So when you do a 1035, you look at an illustration and you look at, is the juice worth the squeeze? Because you're going to have upfront fees. Steve, I would guess 10 to 15% of your cash value would be gone in the first year. But by the end of the first year, because you're putting in more cash or whatever, you're also going to get dividends and stuff like that. So I would guess you might see a 10 to 15% drop in year one. You could be whole by year two. Maybe year three. But you have to look. And then I would say, if it's like a really good, like you said, Penn Mutual, and then we've got maybe Guardian or something like that. Well, it could be that 10% loss, say from switching, maybe like say Penn Mutuals looks better than Guardian, but you start off with 10% loss. Well, it might take 20 years to gain the cash back. Well, okay, then you got to decide, is the juice worth the squeeze? Is 20 years worth getting my money back? Or probably not, if there's not any other advantages. You do want to look at the contract. Contracts will have other stipulations. There could be a chronic illness rider, critical illness, long-term care. There's other features that might be attractive about a policy. So that's good to look at. But all things being equal, I don't want to wait 20 years to get my money back. Now, if it takes 5 years, and then 20 years from now, I've got $1 million more of my cash value, yeah, maybe that's worth it. But if you're, 55, trying to retire at 60, and you want to spend that money or use that cash value over the next 5 years, well, then maybe it's not. So it kind of depends on how you want to use it and what your time horizon is and stuff like that. But that would be my guess, Steve. Every company is going to be different, but I would guess 10 to 15% haircut year one.
All right, thanks a
Great
lot.
question. Yeah. What else, guys?
So when we talk about the interest rates, when you're taking these loans as an investment strategy, how is that set up, and is that variable, or is it a very consistent 5%? You're earning 5% on your cash value. You take a loan, you're paying 5%. How does that set? How does that get changed? And then how do dividends work? Are those a sliding scale as well?
So, yeah, good question, Jake. So just so people know, if you got to drop off, I know it's after 8 or whatever. My feelings won't be hurt. But I'll stay as long as people have questions. So when you go take a loan out, they'll give you an option, fixed or variable. Typically, the variable is probably what you want. Sometimes it's there's different types of loans. Some loans are index loans or wash loans where, if you take out a loan at 5% and your policy earns 5%, they'll wash the loan. So it's basically a 0% is what gets paid. So usually the variable loan has the more attractive features. Depends on the contract. And of course it's variable. So the loans could go up. Typically that would happen if interest rates are going up. If interest rates go down, you might even see it go down. So you get that choice. That'd be the first thing I think, Jake, is you can choose fixed or variable. The fixed is going to be higher, of course, when you start. So most people I find choose variable, especially if you've got a short turnaround time. I'm going to take money out and then turn around and pay my loan off within the first year. Okay, well, variable is probably a good idea. Interest is calculated, I think, daily, but assessed monthly, and you might be looking at 5-6% per year. Again, depending on the company. And then you asked about dividends. Does that answer your question about the loans?
Yeah.
Okay. So then dividends, you asked how do they work? They pay them to you. I know you probably would elaborate on your question a little bit.
Well, yeah, I guess I'm just wondering, the dividends, can they go away? So it seems to me that you would have to be getting dividends in some ways to make it maybe a really good option, a good strategy.
Yes. Yeah. So the dividends are going to be paid from the insurance company out of their profits and earnings for the year, right? So they've got to pay agents commissions. They got to pay for underwriting and all the expenses that they have. So your dividend's going to be based on how old is your policy, right? Year one, small dividend. How big is your policy? But the variable factor is based on the company's earnings and then something called a dividend scale. Excuse me. So a couple things. So here's two things that come to mind right now. One, if you're going to get a policy, buy a cash life insurance policy from a cash life insurance company, right? Don't go to State Farm to get a policy like this because they don't do it. They might I don't know. I don't know, but I don't even know if they can structure them this way. But right, what we're talking about, you want a company that's committed to that product, because no matter what your illustration says, 30 years from now, they don't have to pay you a dividend, Jake. They don't have to pay it ever. Now, if they've built a reputation on paying whole life dividends, there's probably a good chance they're going to pay it, right? If they haven't missed a dividend payment in 175 years, do they want this year to be the one? So in 2008, I don't know, 4,000, several thousand banks closed their doors in during the financial crisis. 4 insurance companies went out of business. 4. These companies are sitting on tons of cash as reserve requirements they have to have. And so they're very financially stable just in general. And that includes like B and C rated companies. So narrow your scope to an A rated company. There's probably 70. It's still too many. And at that point, it's kind of like if you're a recruiter trying to get a basketball team, do you want the honor roll student like with the 4.0, or do you want the kid with the 3.5 but can shoot the lights out of the basket? Like, so once you get like your A carriers, which there's too many to name, then you want to pick the companies that really do that thing well. They do whole life, or they do indexed universal or something. And so there's still probably 10 companies you could use that are going to get the job done. But we all, as agents, we all have our personal favorites. Some of us are captive to the companies we work for. I mean, that's one thing. We have to write certain companies. Others have a contract with different carriers. We can kind of write who we want. For you, that's probably what, the person you want to talk to is someone who has the ability to go outside of their preferred carrier. Because even if it's the best carrier for one person, maybe you, smoke tobacco or have a health history, Prudential or Pac Life might have better underwriting for you than a Penn Mutual or a Northwestern Mutual. So you want to know, so you want that ability to be able to like look at different carriers. So how the dividend works, that answer that question?
Yep, that's good. Thanks.
Okay. And I know I had a little soapbox there, and I feel like I only said one of my soapbox items, but that's okay.
Other
else?
questions for Jameson? No? All right. So thank you, Jameson. This was fantastic. Really appreciate you going through this. As several people have said, we might need a part 2 because this is complicated stuff, but it's really important. And I think, left fielders and we're really realizing how much this can actually help you with your investing, having, multiple rates of return from $1. So I would recommend, if you are interested in this kind of product, this life insurance, you don't need to go to Jameson, but you need to go to someone like Jameson. I use Jameson. I know him and trust him, but like I said, if you have somebody like him, go to them and just start talking about it. Get some illustrations, get some understanding, figure out where they are. And if you don't have someone like Jameson, you can go to jamesonlett.com. I'm not advertising for him, but like I said, I feel strongly that he does a really great job. And so I recommend him, but go to his website and see what he does. We're about 10 minutes past 8. So we'll do networking if people want to hang out. We'll probably just do a couple of rooms, or if other people drop off, maybe we'll just do one room. So I'm just going to pause here. I'm going to stop the recording.